GBP JPY surges near 214 as the yen gives back gains from suspected intervention and carry trade pressure returns. This is not only a pound story. It is a sign that markets still see the yen as vulnerable while Japan keeps policy loose. The confirmed event is that GBP JPY moved near the 214 level after the yen surrendered much of its intervention-led strength. The reason this belongs in a crypto news read is that yen crosses reveal carry trade pressure that can affect global risk appetite, liquidity, and volatility across markets. The opening pressure point is GBP/JPY tests the 214 area against carry demand versus intervention risk. The first confirmed detail is GBP/JPY moved near 214, and the immediate reason to care is that yen intervention gains faded. That means the viewer should track 213 support and 215 resistance instead of treating the first reaction as the whole story. The baseline keeps the story grounded. The confirmed baseline is a move near 214 and a yen rebound that failed to hold. The article evidence ties the move to a suspected Bank of Japan and Ministry of Finance intervention that markets quickly absorbed. Without that frame, it is too easy to treat the event as bigger or cleaner than the evidence supports. The two facts that set the baseline are clear. The yen rebound did not hold, and markets absorbed the official shock. That frame keeps yen gains faded after official action connected to the actual consequence, rather than floating as an isolated statistic. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. In the GBP JPY Surges story, the mechanism is straightforward but important. The mechanism is the carry trade. Traders borrow low-yielding yen and buy higher-yielding currencies such as sterling. When the rate gap stays wide, intervention can create sudden dips without reversing the broader incentive. The viewer should focus on how that mechanism changes access, risk, cost, or trust. In practice, rate gaps keep carry trades alive is the hinge between the confirmed event and the next market or user response. The mechanism split is simple. Carry trades favor higher-yield currencies, while wide rate gaps keep pressure on the yen. If that hinge fails, the strongest title-level claim loses force even if the story keeps attracting attention. The affected side is where the story becomes practical. FX traders, carry funds, Japanese importers, UK rate watchers, and macro risk traders are affected. The practical consequence is elevated volatility in yen crosses and sharp reversal risk around official warnings. For crypto markets, yen carry stress matters because rapid FX unwinds can drain risk appetite. The useful boundary is that FX volatility can hit risk appetite while Japan may act again. The impact split is yen crosses can move risk appetite and FX unwinds can hit leveraged positions. That keeps the impact focused on the people, markets, or systems actually named in the evidence. The confirmed facts stop before the unresolved piece. What remains unclear is whether Japanese authorities intervene again or the BOJ changes guidance. That does not prove that one surge guarantees a straight path higher. A better read needs BOJ policy, new intervention signals, and sustained support above key levels would clarify the trend. This is the line between analysis and speculation. The unresolved split is Japan may still warn or intervene, and BOJ guidance is the deeper signal. The story can stay important, while Japan may act again remains unresolved. But the stronger claim needs visible proof. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The clean trigger to track is this. Watch the 213 support area, the 215 resistance area, and any new Japanese intervention warning. If GBP JPY holds above support without fresh intervention, the story can move from yen fade into level test. For GBP JPY surges, that is the follow-through that matters. The trigger split is support sits near 213 and resistance sits near 215. If that trigger does not arrive, the story may stay in yen fade longer than early attention suggests. If it does arrive, level test becomes easier to evaluate with facts instead of assumptions.